In the UK, the Watford Gap is often recognised as the unofficial dividing point between north and south. But should you be looking for investment properties above or below this line? Hi, my name is Tony Law from Your First Four Houses, and my channel is all about helping you achieve financial freedom through property. If this is your first time here, be sure to subscribe to the channel and click that bell notification icon so that you don't miss out on any of the free content that I give you each and every week. So just before we dive in, I have to make it really clear, these are just my personal views, and I totally accept that not everybody's going to agree with them. You must always do your own really complete due diligence, regardless on where you're thinking about investing in the UK. And I would encourage you to always be really skeptical, dare I say it, pessimistic when it comes to the numbers. And the last thing I wanted to say to you is, I will always maintain I think you should be investing within around about an hour's drive of where you live. I live in the south coast in Poole, for example, and my entire portfolio, give or take, is within about an hour's drive of where I live. Now that we've got all of that out of the way, is there an argument to be investing in the north or in the south? There's certainly this perception, is there not, that the north is for yield and the south is for growth. However, according to the Office for National Statistics, over the past year, there's no question that house prices have been falling in the south and they've been rising in the north. In fact, property values fell by 1.9% in London in the year up to March 2019, but they rose by 3.6% in Yorkshire and in Humberside. And so I have to say, I am now seeing a few pretty convincing arguments for investing up north. For example, yields remain higher on pretty much all property types compared to in the south. There certainly appears to be a net migration of population to the north, encouraged by cheaper housing and a cheaper cost of living. There are some bigger employers moving north. A really great example of this is HSBC, who have opened a fantastic new headquarters in Birmingham. Home working or co-working is really kind of growing. It's making office working less important, and employers do seem to be encouraging this because they're seeing lower overheads as far as they're concerned. HS2, when it finally appears, will make long distance commuting a real and realistic thing. With this in mind, by the way, I would suggest that you consider looking at towns and stations in particular that's along the proposed HS2 route. So what sort of things should you really be considering here? Well, firstly, don't even think of investing in an area unless you have local knowledge. If you don't have local knowledge of an area, i.e. you grew up there, or you go there regularly, or you know people who are there, honestly, I don't think you should be investing there, in my opinion. Focus on satellite towns. And by this I mean, look at a bigger city and then look at the smaller towns that are surrounding those bigger cities, because they're going to be cheaper to buy, you're probably going to get a far better yield, and the people living in those satellite towns will obviously be commuting into the main city. Look for permitted development opportunities. You can buy an entire office block up in the north that's ripe and ready for conversion to residential for far less than the cost of building one from the ground up in the south. I'm generalising there, of course, but I think you get the idea. If you can, have cash ready to invest, because I do think that in 2020 there are going to be some really fantastic opportunities. Don't believe sources. I had a conversation with somebody today who had a sourcer really trying to push them hard on a sale. Just do your own due diligence. Ignore what these salesmen, no offence meant to any sourcers out there, the sourcer, shall we say, is trying to tell you about this property. Do your own due diligence. Check out the price. Be really clear and pessimistic and skeptical about the price and also the demand. Don't take other people's word on it. Invest where there are big or new employers going in, because of course that's only going to generalize, I'm generalizing again here, but that should only mean an increase in demand for your investment property. And lastly, Always factor in my opinion, zero growth. Would you buy that property if it wasn't going to go up in value in the next 5, 10, 15 years? If the answer is yes, if it's giving you a fantastic cash flow, or you found some other way to get your money out of the deal, that could be a fantastic property for you. If you would like a 50-point checklist that runs you through all the steps you need to take before buying that next investment property, simply click the link here or in the description box below and I'll send it straight out to you.